Hey there, traders. Let's get a quick audio and video check in for our bonus session of the non-farm payroll coming up. Just a quick breakdown. What is non-farm payroll? It's a jobs number. It's the most important jobs number. It's the one that just recently on Wednesday, Jerome Powell mentioned that if that number were to be weak, it would most definitely change the way in which the Federal Reserve is looking at their timeline to ultimately some of those rate cuts that we are all widely anticipating. The next meeting is in June, so obviously it's still quite far away. Today's May 3, the next meeting is June 12, and you'll see there is a 91% probability for a hold. We're going to be keeping a really close eye on that. So, jot that down. So I'm going to take a quick, actually, I'll just put it right here on the notes. So the 12 June meeting is 91.3% expectation of a hold. So that's the first thing that we're going to think about in terms of a macroeconomic impact of the NFP. Macroeconomics, gang, it's not a macro big picture look. It's what are those data points that mean the most to ultimately any kind of change of messaging in monetary policy and any kind of change of the actual policy itself. In this case, waiting on those rate cuts. July, all right, so let's jot this down. The July meeting, which if I'm looking at how soon the Federal Reserve is willing to react, that might be about as soon as we could see an adjustment. And right now, and I'm really focusing on the hold, is at, and by the way, how do you know which one the hold is? If the current rate is 5.25 to 5.5 or 5.25 to 5.50, those are basis points, put a decimal in after the first 5, and that's the percentage, you'll see it's a 68.6% expectation of a hold. All right, now this will change likely after the NFP. It just depends on what the NFP comes in at. The next thing, excuse me, the next thing we're looking at is then 18 September. All right, so September 18, this is all the macroeconomic measuring sticks, right? So the hold is at a mere 38.4%. Now you might say, Rog, at what point does the number on the target rate probability mean something? When any one of these columns is at 80, I will consider that fully discounted. Fully meaning there's no possible way to get a consensus of every human on the planet, but that's when it's extremely probable. All right, so hold is only at 38.4. A quarter point cut is at 46.6%, right? And then that's about where I'm most interested. Now, if we jump out to December 18, this is where the year would end. We'll see how many total cuts we could see. Right now, it is likely to see 1, maybe 2 quarter point cuts, but we are still expecting lower rates as we wrap up 2024. Now, I know it's fairly ludicrous on May 3 to talk about December 18, but remember, we are traders and we don't play the now until data comes out, and even that's for a very small period of time. What happens is, what does that mean to us projecting what that could be for S&P trends, for bond trends, for currency trends? What does that mean going forward? And that's what we're going to keep an eye on. All right, next is taking a look at, well, the charts, because after all, there could be a trade. Now, let me mention something. As far as trading goes with NFP, let's move this sentiment and HPMR zones. This is really very, very volatile trading. And what does that mean? That's high risk, right? That's very high risk. Now, in the context of what we're dealing with here this morning, let's just step back for a moment and remember that Apple, a heavily weighted stock, had earnings yesterday, and the big takeaway with Apple is that their most positive things we can say about Apple is that the bad news wasn't as bad, right? That's part of what's good. If we're expecting something bad, we get something less bad, that then equates to good. But the real story here was the largest buyback in the history of any company, $110 billion buyback. And that's where we sit right now on Apple. And of course, what does that mean to the view that we're going to see of the S&P and the NASDAQ as we prepare for non-farm? It should be moderately stronger because, well, we're expecting a fairly significant gap up in Apple. Apple is heavily weighted in the NASDAQ. It's heavily weighted in the S&P. Heck, it's pretty darn heavily weighted in the Dow as well. But the biggest impact on the NASDAQ is going to be Apple this morning. And Apple has a far more disproportionate influence on the NAS because there's only 100 stocks there. And Apple is a huge weighted stock within it. There's 500 stocks in the S&P 500. So while Apple is heavily weighted, it's one of 500. So obviously the impact on the NAS is going to be far larger. All right, so that takes us to what we want to do, or more importantly, what we don't want to do for non-farm. So first of all, if you've never traded a high impact hot zone before, a scheduled high impact, high volatility economic release, I would not recommend ever trading this until you've got quite a few of these under your belt. The last one that we traded was the PCE. So these are high impact macroeconomic hot zones that we're expecting to alter some expectation of what the Federal Reserve is going to do this year. The sentiment for our indices at 8:21 this morning is really simple, above the previous session close. So we're going to use those same sentiment reads. Now, what is also interesting is the daily NAS is testing the VWAP today. So after we get through non-farm payroll, if the NAS can get back above that anchored VWAP, which by the way, is anchored on the 2nd of January, it's the first trading day of this year. So that's where that VWAP is anchored. If we can get above that, which would also mean we're likely getting above 17,800, that would be pretty darn bullish as we go into the weekend if we can close up above that level. All right, so those are kind of bigger picture, way after NFP type implications. Where are we going to end Friday? All right, the next thing I want to look at, and this is where we get to the nuts and bolts of the trading. Look at the way in which the hourly price movement ranges are really far apart, and the size of each one of those zones, the red and the green, are really quite large compared to, say, 7 to 8. That tells me two things. One, the volatility is going to be far greater for 8 to 9 a.m. The second thing is this entire zone, this red zone, is resistance. This entire zone, the green zone, is support. Being above the PSC, I'm a little bit more interested in the green zones, right? So what don't I want to do? I'm not a huge fan necessarily of the short, but you'll see we're just barely above the previous session close. So it's not as if we have a really huge firm footing above it, but you'll see we've been bouncing off this level all morning long. There's some relevance to that. The next thing I can take a look at is then what is the definition of the green zone in two symbols. The two symbols, look, there's only so much we can keep an eye on when things are so volatile. ES and NQ. What would I not recommend trading during non-farm because the volatility can be way beyond what we typically see? Bonds, euro, really any currency, any treasury. I would not recommend gold either. So keep it focused on the ES and the NQ. Pick one or the other, or keep an eye on both. So we're going to actually map both the zones here. Now, I'm going to go ahead and share with you how we do the three levels we can focus on. So the closest I would even consider an ES trade is at the lower edge of the green zone, and that's going to be 17,695 and 64. So I'm going to move that up to 17,695 and 3/4. You can move it down to, whichever way you want to average up or down. A quarter point's not going to make any difference. Right in the middle of the zone, we're sitting at 17,663 and a half. And at the very bottom of the zone, we are sitting at 17,630 and call it a half. Agro, Moderate is in the middle. Conservative is at the very bottom. Conservative is a great place to, if you want to position yourself in an event where we expect a lot of volatility. Moderate, conservative, those would be great places to consider your entry. Now, how do we enter? Limit orders. Limit orders. No market orders here, gang. Limit orders. Now, that's the green zone. It doesn't hurt to at least know what the red zone is. So the red zone is sitting at 17,821. So I'll put that in there. Oh, sorry, I have the NQ up right now. Hang on. There we go. NQ. All right. So the upper end of the range is 17,821. The middle of that zone is 17,855 and a half. And then the very top, the conservative, is 886 and call it a half. Now that would be one of two things. That would be where I would look at limit orders to sell, right? Or that could be a second target. That could be a second target on the way back up if I get a fill that's long. Now again, notice we're not using market orders. Please remember that, no market orders. The very middle of that zone, I'm going to put here mid. That's our first target, and that's 17,758 and a quarter. All right, you can go 17,758 even. All right, this is only futures trading, gang. This is futures trading. At 8:26 in the morning, what's not open? The Wall Street bell has not rung. This is not about options on the QQQ or options on the SPY or trading the ETFs. Wall Street, for all intents and purposes, is not really accessible. So this is really very much a futures trade. All right, so let's jump on over to the ES and do the same thing. All right, so once again, I'm going to grab the middle of the range. Now, futures options are fine, but remember, there's an extra step involved in waiting for the ES or the NQ to reach these zones and then placing that order with the option. So just remember, it's a little bit more cumbersome to trade the options. And by the way, this is the NQM24, which is the June contract, and this is the ESM24. All right, the next thing is green zones. 5,095 and 3/4. Then the middle of that zone, 50,87 and a half. And then lastly, the very bottom of the zone, you can see there is at 50.79 and a quarter. Now you notice the hourly price movement range tool on the chart, or volatility analysis, is going to have numbers that we don't trade at because it's just a calculation. It's just crunching all the data and how many points we could move. So it's our job then to move it to the quarter point, right? Because that's how the S&P actually trades. All right. So that is the green zone. And that's really what I'm favoring if we're above the previous session close. Now, as we mentioned, we could be easily flip-flopping around. So I'll talk about the other thing we're going to do, which is bracketing, which is why it's important that we have all these levels in front of us. So 51.24 and a half, 51.33, and then lastly, 51.41. All right. We can place limit orders on both the buy in the green zone and limit orders to sell in the red. So this is bracketing, right? You would have waiting orders at both ends. Whichever triggers first, that's your entry. Whichever would trigger second would be a second target. And the middle of the zone is actually right where the point of control has been thus far this morning. I don't mind to keep an eye on that, but the middle of the zone's roughly 51.09 on the ES. So our mid is 51. All right, there we go, 51.09. That's it. Do not place the target. We do not know which way the trigger is going to happen. Again, we want to have as firm an idea of whether we're up or down from the previous session close for some sentiment. We really don't have that clarity here. So the lack of PSC clarity in terms of our directional bias causes us to consider the bracket. Now, if you want to say, Rog, I'm only looking long, totally fine. Rog, I want to pass on this. If there's ever sort of a pass barometer, it's going to be this lack of clarity around the previous session close. All right, keep that in mind. Now, notice not once am I looking at what's happening with the number itself. I don't care what that number is. Again, we'd rather be on the long side because we're just barely above the previous session close on the NASDAQ. I'm going to head on over there. And what we need for the buy is for price to get down into the green zone. So unless the price gets down to 17,695, there's nothing for me to do, right? Our bias is to the long side for all the reasons that we just discussed, whether that be Apple, which has already got the NASDAQ and the S&P in a rather good mood, and the fact that we're, especially on the NASDAQ, at least a little bit more clearly above the PSC. So you can see how important that directional bias is. And if we don't have the directional bias as clearly like we have on the NAS, the S&P wasn't all that good, pass on the S&P. Obviously, we're heading higher. Directional bias, sentiment reads were spot on. I did not get my fill. And that's really it. So you might say, Rod, can we short this? I would not recommend a short. Being above the previous session close, that sentiment read highly suggests that the follow through is going to be to the upside. Now, if you've been following along with the conversation that we've been having since Wednesday, and even the non-farm payroll expectations, the video that I sent out to members yesterday after the close, immediately after the close, we said, look, this market is extremely excited for NFP because Jerome Powell put it on the map by saying, look, if that jobs data is weak, that's going to alter our expectations. Do I have a fill right now? I do not. I'm going to take a lot of solace in the fact that the sentiment read was spot on. And then I'm going to step back and say, it just did not get to my zone before snapping back up. You can see the speed is why we must have limit orders. This cannot be a market order. You can get filled anywhere in this crazy candle. Please do not, in any walk of life, focus on market orders, but most especially for hot zones. All right. Okay. The next thing we're going to do, I'm just going to jump on over to the economic calendar. What was the data? It's the least important facet of trading for me when we have a hot zone. The most important is, where are those levels? So we have to think about expectations. So the actual non-farm payroll was awful. NFP has come in at 175,000 versus expectations that were as low as about, and I'll show you the expectations in a moment. Let's jump on over to our calendars. So what were the expectations? What was the market calibrating for? Expecting. I've seen expectations as low as 218,000 to as high as what you can see on the screen here, 238,000, right? So that is what we were expecting. Now, I want to mention banks will have their numbers, institutions will have their numbers. There's no one consensus. It is a range. So when I look at 238, obviously this is far weaker. What else do we see? The unemployment rate kicked up. All right. Unemployment kicked up from 3.8 to 3.9. Now, it was expected that we would stay steady at 3.8, which is where we were before. And you can see that this is now higher than that, which is worse, right? So this is still very much poor jobs data is bullish. This is still where a bad news is good or bad news is bullish. And what would be bad news? The bad news is that by keeping rates higher for longer, the presumption is Federal Reserve, Jerome, Powell, you are hurting the economy, you are hurting the jobs. Remember that the U.S. Central Bank has a dual mandate. That means that there's two things they've got to consistently monitor as they're getting to their monetary policy target. And that is not just getting the inflation to the target that they've been talking about, but also not damaging jobs. They have a dual mandate of inflation and jobs, which makes them unique amongst the G7, G8 central banks who are really looking solely at inflation. So Jerome has two jobs, two hoops to have to jump through all the time, which is why employment numbers like the non-farm payroll, the rolling 4-week average of the unemployment claims that we get every Thursday, JOLTS numbers. That's why these are so important, non-farm being the most important of all of them. All right, so that's what we've got. And as long as this number is very, very good, as long as we're above the previous session close, there's absolutely nothing to have to do. Nothing we want to do. So let's go back to the charts. That previous session close, I hope everyone sees how important that is. We do this with our day trading anyways. What is the sentiment read? What are those lines in the sand? And, some really important ones would be previous session close. Another important one would be looking at, say, the 200 propulsion on the 5-minute chart. Another one could be, an anchored volume weighted average price. If you're going to anchor a VWAP for non-farm, anchor it to either 2 a.m. Eastern or 7 a.m. Eastern, because obviously we're not going to get the 9:30 until 9:30. And that's really the way in which we look at NFP. Again, above the previous session close, I don't want to short. Notice that a lot of traders, likely after this large candle, did one of two things. They either bought, and this was a 140-point move, conservatively. They either bought after the 140-point move. I don't recommend that. Or worse, they shorted. Definitely don't want to do that. Ultimately, we're going to have what's known as an echo at 9:30. So what is the Wall Street echo? What that means is there is an entire group of traders, stock and stock options traders, that don't really have access to this time of day. It's 8:30 in the morning. It's an hour before the bell. And so this becomes the futures markets are responding, and even the Forex, by the way, are responding to the data. And then at 9:30, when the bell rings, we're likely going to see now that second wave of participation via equities and equity options start to flood in, and they're going to echo what has happened because they really weren't able to join in this like futures traders could. So that means that at this point in time, what do we know? Well, likely the Wall Street buyers are not only going to love that Apple news, regardless of the fact that it's up on a monstrous buyback, they're going to love this NFP being, frankly, lousy, right? That's not just a slight miss. That's a pretty significant miss. And I'm not saying that. You can see here, equities are saying that. Now let's take a look at a couple other places. If this is, in fact, suggesting, now let's talk about the macro. Let's kind of flip the switch and talk about the macro implications. Macroeconomically, if the NASDAQ is up and the expectation is for lower rates sooner, there's just a few places we can look. We'll get to the target rate probabilities. Give them a few minutes to settle down because that's a futures contract, the Fed Fund futures, that then the Chicago Mercantile Exchange then turns into those graphs that we were looking at the early part of this session. So ZB shooting straight up. That's the 30-year bond. If that is moving higher, that is actually inverse to the yields. That means yields are going down. So the direction of the contract is opposite of the yield. If that goes up, yields are going down. Same thing with the 10-year. What about gold? Would gold respond to this? Gold should be moving with the real yields, and it should look like bonds, and it does. All right, what about the US dollar? Is the dollar weakening? Because remember, whenever a central bank is cutting or expected to cut, that should weaken the currency of a country. The best way to look at dollar is through the euro, right? We don't want to look at the basket, right? We don't want to look at the basket. We want to look at as direct a relationship to the dollar as possible. And that's actually the euro US on Forex, or the 6E in futures. This is the euro versus the US and nothing else. Why the euro? Why not the yen or the pound? Because 58% of the US dollar basket is euro. So this is an absolutely inverse or negative correlation to the dollar. The dollar is going to be sinking, the euro is going to be rallying. These are all signs when we take a look at the actual symbols that would respond to NFP and an expectation of rate cuts sooner. This is exactly what we would want to see. But let's just look at it now through the Fed Fund futures. So I'm going to head back on over to the graph that we started this conversation off with. What are we expecting for June? Are there any shifts? Remember, we really didn't expect June to do anything, and it might take 5 or 10 minutes for this to kind of really readjust. So I'm going to refresh this page, and we'll continue to see these move throughout the morning for sure. So nothing in June. Really nothing, and it still might be a little too early to see any real movement here. Nothing in July that's really changed yet. It's only been 9 minutes. And are we seeing anything in a little bit of a move in September? So what we'd really like to see, if Fed Fund futures are increasing the probability of a rate cut, we want to see most definitely September, this 500 to 525 column, move higher. And this can be a little slow. Remember, Fed Fund futures have to make their trades just like the NASDAQ futures and the bond futures and the Euro futures. Fed Fund futures have got to make their move, and then it'll be processed by the Chicago Mercantile Exchange and give us these target probability charts. So they'll probably move around here a little bit, but we'll see what they do after the bell, after the Wall Street bell, and see where they sit. So not a lot of movement there, but it could be a little early. And that's it, gang. That's the way we look at this hot zone. So what ultimately happened? We had, for sure, bullish directional bias because we were above the previous session close in the NAS. S&P was meh. So S&P would be a great one to say either I'll bracket or I'll just pass. Because we did not have a lot of space in terms of price action and the previous session close, it's an easy reason to say also pass. But again, being above it, the way the NASDAQ was, it made sense to focus on the green zone. We ultimately did not get down to about 17,695, even 17,007 to get long, because that's where the limit order to buy would be waiting. But nonetheless, if it's not a trading event, it certainly still will be an event where we can understand a little bit better the bigger picture implications for what the Federal Reserve is going to do. And a jobs number like this, right? A jobs number like this is going to obviously boost expectations that the Federal Reserve is going to have to do something sooner rather than later. All right. So let's see what we have here. I'm going to take a look at our room. And so there's a couple things so if you're in the Sector Secrets Mastery room, I'm giving you all the broad strokes for the most conservative approach to this event, to this type of trading. The next thing to remember is there's multiple ways to take advantage of this move. And one of the things that the Lorna bot does in the Sector Secrets Mastery, and this is a little bit more advanced, but it's the same concept, right? The foundation is still the same, high volatility, high impact. But now we're trying to factor in what are other ways to take advantage of it. The Lorna bot will put on what's known as a strap straddle. So what she'll do is she'll buy 2 calls and 1 put because we had bullish directional bias. Remember, it's the same foundation in terms of directional bias and zones, but now we're trying to take advantage of it in a different way. In this case, it's getting long and having the safety net of a put. So 2 long calls, 1 put in the MES, the micro S&P. You could do the same thing in the micro NASDAQ, right? So if I'm a little bit more bullish to the NASDAQ, then the MNQ would be another way to take advantage of it. And that's really what is then another level, right, of strategy we can take. But it's all going to be predicated on the same process that you just watched me do. All right, so let's take a look. Strip and strap straddles is something that the Lorna bot teaches in the Sector Secrets Mastery. It's a classic and very seldom discussed process for being able to put on a directional trade with options and a safety net. It's one of my favorite things to do. It has directional bias. It's really not a neutral strategy. And I'm not a big fan of neutral strategies. Therefore, strip and strap straddles are really interesting opportunities to take advantage of a high impact event like this. So that was something else that I can see a lot of you were doing in the room. All right, so let's see who put that strip or strap straddle on. Again, remember the foundation is the same process that you watch me do. We start every single hot zone, not just non-farm payroll, with that assessment, wanting to be bullish. Why 2 calls and a put? Because the 2 calls suggest the bullish directional bias that our indicators, that our read, that our sentiment is telling us. So let's see. What do we have here in the room? Who put that on? Genesis Maria. Did you just put that on for holy cow, $126,000 trade? Wow. Wow. All right. Dinner's on Maria tonight in Paris. All right, that's fantastic. So that gives you an idea of what's possible. Wow, what's possible. But remember, the foundation is still very much our top tier, our hourly price movement ranges, that directional bias sentiment read, line in the sand. And that is, wow, that's fantastic. Congratulations. Remember, whether it's $125 or $125,000, holy cow, those types of opportunities are going to come. That directional bias, that confidence about how we want to put on the trade, the timing of the trade, those are all going to be basically built, right? The basics are what is the expectation for the move, working the probabilities, and congrats. Bot did pretty well too there. Okay, awesome. All right, so that's a wrap. That's non-farm payroll. And in terms of, wow, in terms of what this event is, remember, please remember, this is a futures event. You can trade futures options. You can trade the micro, you can trade the mini. This is a futures trading window because it's before 9:30 a.m. And yes, if the futures markets are open, futures options are also a viable choice. Not the stocks, not the ETFs, but remember, we'll have the Wall Street echo, so we'll see what we get once the bell rings in about 45 minutes. All right, gang, I'll see you in the next Hot Zone event.